Let's start with New York Community Bank, much in the news this week. What do we think we know about what happened there? And is it a one-off, do we think, or does it say something more broadly about regional banks?
Well, no, I think it says something about the commercial real estate markets, especially in urban areas. Office commercial real estate in urban areas is suffering. A lot of some of it's interest rates, some of it's just their transition to remote work and hybrid work is reducing demand for office space and creating high vacancy rates and stress for the landlords. And then if they have to refinance, I think about a $500 billion is refinancing this year. They're going to have to refinance at higher rates. So that's what's going on. It's really more about commercial real estate than New York Community Bank. They do have significant exposure. It seems to me they were under reserved. They added a lot to their reserves in their most recent financials, which is a concern. But hopefully they've got it covered now. We changed the rules a while back to require banks to reserve against expected losses on their loans based on a forward-looking through the cycle, looking at all market conditions. And the FDIC put some really good guidance out about this last year, reminding banks that they're supposed to be looking at all market conditions, not just historical performance, which is pretty good. But historically, you didn't have this problem with remote and hybrid work. So, other banks may be under reserved. They'll need to get those reserves up, and that's going to cut into earnings. But hopefully that plus their capital base will be sufficient to get them through this.
So some of the disruptions we're seeing at some banks now coming against the backdrop of proposed new capital requirements tied to Basel III, as I understand it, to bring us into compliance, that it is said. Give us your sense about those capital requirements and how they would affect the banks, although things I've read suggest it really falls more on some of the regional banks than on the very big ones. Yeah.
Well, actually, the bulk of the capital increases would fall on the largest banks. Now,
but it's said that the largest banks already have enough reserves, right? That they already have enough capital, is what I've read at least.
Well, it will increase their regulatory minimum capital requirements. No, for the Basel III endgame, that still will primarily impact the largest banks. And I'm glad you asked this because those rules really, the impetus for those rules was the great financial crisis. And their primary impact is on market risk and operational risk, not so much credit risk, which is what we're getting into now with commercial real estate. So there will be impacts on the regional banks. They do lower the higher capital requirements to $100 billion and above from $250. So yes, that's going to have an impact. But there's a very, first of all, those rules are far from being finalized, and it'll be many, many years before they actually come into effect when they do. So I think investors are overreacting to the prospect of those rules now. There is not going to be really, for better or worse, there's not going to be any real immediate impact on these banks. There's a very long transition period for them. And again, most of it is actually falling on the largest banks, especially ones with big investment and trading operations.
And the banking industry doesn't seem to like what's been proposed so far. I think it's fair to say.
That's for sure.
Not a big surprise, and they've pushed back hard. But
yeah, they have.
From where you sit, do they have a point? Because one of the claims is it's going beyond what Basel III actually requires, and it's addressing some things that really aren't problems. Do the banks have a point?
Yeah. There are many things about this proposed rules I don't agree with. And so I think they have legitimate arguments on certain aspects of the rules. I think a larger issue is around complexity. But what they're really just saying, their raw argument is any increase in capital is bad and it's going to hurt us and Main Street, et cetera. And they raise a lot of false arguments. We've heard over and over again. The common one is that's going to hurt lending. It's going to constrain lending. First of all, these rules primarily impact trading operations and trading and operations, not lending. Actually, in aggregate, capital requirements go down a little bit under those proposed rules for so-called credit risk. So, and even if that was true, well-capitalized banks do a better job of lending through the cycle. You want them to be resilient enough. We've been talking about the situation we have now with commercial real estate. This is going to create increased credit losses on the banking system, and large banks have some exposure here too. Also, as monetary policy tightens again, you have market law inflated asset valuations adjust, low-yielding assets lose market value. So when we get to these cycles of monetary tightening, we talk about a hard landing. But the way you avoid a hard landing is to make sure the banking system has enough capital to absorb the kinds of losses we're seeing right now, which come with monetary tightening. So this protects Main Street. And I think, again, the banks would do better if they narrow this down to certain areas where I think they have a legitimate argument. Mortgages is one, but that's just wholesale. Any raising capital is bad. It's going to hurt Main Street. It's going to hurt their margins is what it is. I mean, capital just relates to how much leverage you can use. And if markets are good, you use a lot of leverage, that increases your return on equity. Of course, when markets are in bad shape and you're losing money, it exaggerates your losses, which is why bank regulators really want to make sure leverage is constrained and they have adequate cushions of capital. But yeah, I do think there's a lot of false narrative around this. They do have some points, but they're not confining themselves to where I think are more legitimate policy arguments. They're just, whole hog, capital's bad, raising capital's bad. And that's just not the case.
Well, capital, obviously, you want banks to be really well capitalized. You want some capital buffers in there. Same. I assume, though, at some point you can actually ask for too much capital. There is some cost benefit, is there not? And as a bank regulator like you were at the FDIC, do you take into account that cost benefit?
No. There's an ongoing debate about that. I mean, because, in the past, when you've raised capital, actually banks' cost of capital goes down because bondholders have more confidence in their stability. So the cost of capital in issuing debt is going down. So there is kind of a debate about, how do you calibrate, and when it's not necessarily true that just raising capital is got a cost. What it does do is, so the risk-based standards, which are the primary ratio that are used by bank regulators, that basically categorizes assets by their risk and saying, you can use this much leverage for things we think are low risk. You can use a lot of leverage. For things that we think are high risk, you can't use as much leverage. And so it really just, it guides how profitable these different asset classes can be based on the amount of leverage banks can achieve. So that's what's going on. Capital isn't just trapped money. Capital, it just relates to the ratio of how much equity you need to use to fund your operations, fund your investments, fund your loans, versus how much debt you can use. And the more, as anybody knows in business, the more equity you have, the more stable you are. That's your defense against insolvency, and for taxpayers, it's our defense against having to bail them out again. So, I think it's an academic debate to ever argue whether capital could be too much. I think you would have to get to the point where, be 25, 30% for you to actually say, well, maybe that's too much. I think 10% would be a good number. We're not on a non-risk-weighted basis. We're not even close to that. So it's really theoretical because these banks, whether they want to admit it or not, they're better capitalized than they were prior to the great financial crisis, but they still operate with a lot of leverage. And bank regulators do need to be concerned about whether their capital levels are high enough to protect the real economy and to protect Main Street.